This is our final section of the savings and investment chapter, and this is going to be a supply and demand model for the market for loanable funds. Supply and demand model of the financial system, and it helps us to understand how the financial system coordinates savings and investment, how government policies and other actions affect savings, investment, and the interest rate. Now we're going to assume only one financial market. All savers are going to deposit their savings in this market, and all borrowers take out loans from this market. So it's going to be a, shall we say, closed system. And there is one interest rate, which is both the return to saving and the cost of borrowing. Supply of loanable funds comes from savings. Households with extra income can loan it out and earn interest. Public saving, if positive, adds to national savings and the supply of loanable funds. If negative, it reduces national savings and the supply of loanable funds. Okay, and we're going to be looking at the interest rate and loanable funds. The interest rate is going to be, in this case, the cost of money. And our supply curve is going to be upward sloping. And an increase in the interest rate makes savings more attractive, which increases the quantity of loanable funds supplied. So if one gets a higher interest rate, one will loan out that much more money. Demand for loanable funds comes from investment. Firms borrowing the money they need to pay for new equipment and factories. Households borrowing the fund they need to purchase new houses. And here's the interest rate and loanable funds. Demand curve slopes downward. And a fall in the interest rate reduces the cost of borrowing, which increases the quantity of loanable funds demanded. So if the interest rate goes down, I will borrow more money as a result. And this is true for borrowing money for capital equipment, as well as it is true for borrowing money for a new house, a mortgage perhaps. It's all loanable funds. And so think of loanable funds as a massive pool of money that you can access by borrowing it. And borrowing it, of course, means you have to pay it back. But the price of that borrowing is going to be the interest rate. Okay, and here we have equilibrium. Interest rate adjusts to equate supply and demand, 5%. In equilibrium, 60 loanable funds. And this is going to be the forces of supply and demand. Giving us one equilibrium interest rate and one total amount of loanable funds. And this is a good place to start, but just keep in mind that, let's see, when you put your money in the bank, there's a pen, all right? You put your money in the bank is going to pay you a certain amount of interest, which is right here, and then loan it out at a higher rate of interest right here. The difference right there is called the interest rate spread. So the less banks there are, the higher this interest rate spread can be. The more banks that exist, the lower the spread will be, and the more we will approach the one solid interest rate, which is right there. Okay, let's shift some curves and see what's going to happen. Oh yes, equilibrium quantity of loanable funds equals equilibrium. EQM is their shorthand for equilibrium. Investment and savings. Okay, savings incentives. Tax incentives for savings increase the supply of loanable funds, which reduce the equilibrium interest rate and increase the equilibrium quantity of loanable funds. So anything that gets people to put more money in the bank, let's say there is a guarantee or there's going to be some kind of a tax write-off, that will put more money in the bank. Investment incentives, let's say there's an investment tax credit in which you invest money in a certain, you get a tax credit for investing in a certain company. That's going to increase the demand for loanable funds, which is going to raise the equilibrium interest rate and increase the equilibrium quantity of loanable funds. Now, we have a little exercise here. Use the loanable funds model to analyze the effects of a government budget deficit. Draw the diagram showing the initial equilibrium. Determine which curve shifts when the government runs a budget deficit. Draw the new curve. And what happens to the equilibrium values of interest and investment. So, we have a budget deficit, reducing national savings and the supply of loanable funds, which increases the equilibrium interest rate. Uh-oh, this is not good. Let's find out a little bit more about this. Increase in the budget deficit causes a fall in investment. Government borrows to finance this deficit, leaving less funds available for investment. This is called crowding out. Now, many people now are looking at the massive increase in our budget deficit and looking at this crowding out analysis and saying that there's going to be less funds available for investment, so don't have a budget deficit. But there's a lot of debate about this, and a lot of it comes from the loanable funds model as well as some more advanced models that you'll learn in intermediate macroeconomics called ISLM. Okay, recall from the previous chapter, investment is important for long-run growth, hence budget deficits reduce the economy's growth rate and future standard of livings. But again, the issue is short run versus long run. Okay, the government debt. Speaking of long runs, the government finances deficits by borrowing, selling government bonds. Persistent deficits lead to a rise in government debt. And the ratio of debt to GDP is a useful measure of the government's indebtedness relative to its ability to raise tax revenue. A rise in government debt also means that the government is a form of crowding out as well. The government must pay more of its budget to interest rate payments on debt holders than it would to other things such as national defense, infrastructure, education, entitlements, and so forth. Historically, debt-GDP ratio usually rises during wartime and falls during peacetime until the early 1980s. Yep, and here is a chart that shows government debt, Revolutionary War, World War II, and 67.1% in 2010 estimate. Look at World War II. The debt to GDP ratio was in excess of 100%. If you could just draw that line, excess of 100%. Some countries now, such as Greece, already have a debt to GDP ratio of over 100%. We have 67.1%, and probably is going to be going up given our economic maelstrom that we're in right now. And that's a big issue. Do you increase the deficit and increase government spending and put people in jobs because we have a high unemployment rate right now, close to 10%, or do you worry about the impact of this increased deficit on future investment and crowding out in the future? That is a huge debate going on right now. Okay, conclusion. Like many other markets, financial markets are governed by the forces of supply and demand. One of the 10 principles from Chapter 1, markets are usually a good way of organizing economic activity. Financial markets help allocate the economy's scarce resources to their most efficient uses, and financial markets also link the present to the future. They enable savers to convert current income into future purchasing power and borrowers to acquire capital goods to purchase goods and services in the future. And this, I believe, ends the chapter on savings and investment.